Does it change anything for you, Tony, or are you fading it?
Well, Sarah, as you know, we expected the summer rally, and it met all the parameters that we're looking for. Truly, Sarah, the whole reason that you had that first half tumultuous behavior was on the back of fear of Fed. And that fear of Fed is about the economic slowdown. So certainly a lower CPI is going to help reinforce the economic slowdown. And therein is where the problem may lie later in the year when that becomes a reality.
So you think this is just, the final innings of the summer rally?
Yeah, I do. Well, forget about my opinion. I'm about the data. The data that we have, remember the indicator we used, which was a 10-week rate of change, just a very simple indicator on the S&P. And when you've had it drop by minus 15, so I call it a whoosh, a technical term, where you get an extreme selling, it's only happened 16 times since 1957. And when it's happening and it's pivoted higher, the only time that you didn't have some kind of test of the low or some kind of pullback, literally after a median 14.96% gain, is when the Fed has already started easing. So obviously that's not the case. And just like it felt so wrong to look for a summer rally 6 weeks ago, it feels so wrong not to be chasing the upside with a lower CPI print. And I think that's really, I want to be careful to not, sell into extreme whooshes and buy into extreme ramps.
Well, and there's also, this old saying, don't fight the Fed. I feel like that is what the market is increasingly doing here. Even with the inflation report today showing some easing, we've had two Fed presidents out. We've got Kashkari of the Minneapolis Fed, who's gone from uber dove to uber hawk now, saying we're far, far, far away from declaring victory on inflation, and that he expects 3.9% for the terminal rate this year, 4.4% next year, which is one of the most hawkish. I think it is the most hawkish expectation. That the consensus of the Fed is closer to around 3.5%. Evans of Chicago says inflation is unacceptably high. Unacceptably high. So is the market ignoring this at their peril?
Well, I don't know if it's ignoring it at its peril, but it's ignoring what the Fed is telling them, which it's interesting. Today, for example, the 2, 5, 10-year paper was, down double digit, 10, 11, 12 basis points, even up to 18 basis points. And that's all reversed higher the last I looked, so that it's just down a little bit on the day. And I think it was the positioning. Sarah, remember the summer rally conditions where you had an extreme oversold condition, like a historic oversold condition. You had excessive fear of the Fed. That's obviously no longer there any more than the oversold condition is, and as you point out. And then lastly, and this is the most important, there's an excessive fear of economic activity. Nominal growth in GDP was 7% in the last reading. So I get it. The academic study says 2 quarters in a row of negative GDP is a weak economy. It was simply too soon to expect the higher rates to negatively impact economic output. That's saved for really at the end of the year and into next year. So the first fear of a market decline is fear of what the Fed's going to do, like fear of Fed. Then you get the comfort that, okay, maybe it's not so bad. The pendulum swung to excessive, now down to the sweet spot. To expect it to stay here without any economic issues on the back of this kind of Fed policy is to expect that pendulum to stay there and not swing this way. From here on in, it's about economic weakness, not higher inflation, once we're done with the summer rally, which obviously is continuing on a little bit today.